Recent tariff actions by the United States have heightened volatility for broad financial markets. They've increased investor focus on listed infrastructure. We have three key considerations for investors in listed infrastructure today. Number one, our analysis of listed infrastructure earnings in the wake of these tariffs. Number two, the resilience of listed infrastructure and its ability to perform across different economic regimes. And number three, the valuations at which listed infrastructure trade at today and their implications for the long-term potential returns of the asset class. I have a few materials I wanted to share to elaborate on these three key points. If you have any further questions after this, please reach out to me or please reach out to your CBRE IM representative. So turning to the first slide here, what we've charted is infrastructure EBITDA per share growth indexed compared to global equities and inflation over the course of time. What you can see is that listed infrastructure cash flows tend to outperform that of broad equities, and they also do that with lower volatility. When we look at the infrastructure asset class in aggregate, over the next 2 years, we expect 7 to 8% earnings growth. That's a premium to long-term averages of approximately 200 basis points, which is very important. It's driven by a lot of secular themes across infrastructure assets and sectors. When we think about the sector implications of recent tariffs on listed infrastructure, starting off with global utilities, we see earnings as exceedingly resilient. Utilities are compensated based on the prevailing cost of capital, and they're also compensated based on the capital that they deploy. And so as construction costs rise, we think utilities are very well positioned. Utility earnings do tend to be very resilient. They are girded right now by secular demand thematics like generative AI, like power demand, like the potential for power demand to augment still further with the reallocation of manufacturing capacity to the United States. And so utilities are very much in a good spot. We are monitoring things like global renewable developers, where increased costs to construction have the potential to impact project level returns. But again, particularly for onshore, large cap, well-capitalized renewable developers, those companies tend to have a very strong history of managing supply chains well, particularly during either changing tariff regimes or economic uncertainty. Other areas of listed infrastructure to note, global transports. Certainly, we do expect some sensitivity here from global ports, from global freight rail, the potential for a pullback in consumer demand to impact traffic at leisure airports. We expect resiliency from global toll roads, which have multi-year long-term duration concessions, as well as some very strong inflation capture mechanisms in their contracting. And broadly for transports writ large within infrastructure, I would say that one should expect less sensitivity compared to more commoditized or more service-based transport businesses. Other areas of infrastructure would be the communication sector as well as the midstream energy sector. In communications, we expect a continued sensitivity to long-term government bond yields. So in a period of increased uncertainty and lower yields, we expect those businesses to perform well in total return. We expect resilient earnings, though we continue to monitor telecom carrier demand. And we are monitoring the cost of construction, particularly as it relates to data centers with development arms. Within midstream energy, our focus on risks remain those that are volumetric in nature. The degree to which hydrocarbons can grow across North America, very much a driver of fee-based contracted returns. Broadly speaking, the businesses much improved over the course of the COVID-19 pandemic, financially, operationally, reduced sensitivity to commodities, and again, lending support to all of infrastructure when, again, taken in aggregate, are producing that 7 to 8% earnings growth over the next several years with, I think, a high degree of certainty. That earnings resilience of listed infrastructure has lended itself to outperformance during periods of uncertainty. So what we show here is the annualized total returns of listed infrastructure and of broad equities dependent upon economic phase. First one, a moderating economic regime. That's the one that we expect to persist. Infrastructure has delivered approximately 700 basis points. of annualized outperformance, and then has gone on to outperform if economic conditions worsen and we enter a contraction regime. Given that sort of backdrop, I think that the current valuation setup for listed infrastructure is exceedingly favorable. You can see that the discounts that have arisen over the course of the COVID-19 pandemic, as well as the global central bank hiking cycle, a derating of infrastructure on EV to EBITDA multiples in absolute terms, and certainly so on a relative basis. And so as of the end of the first quarter of 25, listed infrastructure trading at an 8% discount compared to broad equities, compared to its history of a high single-digit premium. And the implications there for total return are significant. Listed infrastructure is offering a gross 3.5% to 4% dividend yield. It's offering high single-digit earnings growth potential, and it's offering the potential to recapture the multiples which were lost over the course of approximately the last 5 years. All of that forms a very strong, we think, asset class proposition for investors, which active managers like ourselves have the opportunity to augment still further from a niche asset class with vast links to the private market. So those would be a few comments on listed infrastructure, key things that we think investors should be considering today. If you have any questions on the listed infrastructure asset class or on real assets more broadly, please reach out to me, reach out to your appropriate CBRE IM representative, and I wish you good luck with your endeavors over the course of 2025. Thanks very much.